Well, South Africans have been dealt another blow with an already weak economy, rising food and fuel costs, and ongoing power price hikes. They now have to pay more for credit. The Reserve Bank hiked the repo rate for the first time in a year. CCTV's Sumitra Naidu reports it's raised concerns of a sudden spiral in inflation.
Interest rates are used by central banks to control inflation and stimulate growth. Low interest rates in South Africa has helped to cushion consumers, but has done little to lift growth in the last year. The economy is growing at just over 1% and inflation is ticking up. Consumer confidence is at its lowest levels in 14 years. The latest interest rate hike could see a further slump.
It will weigh on consumer confidence, consumer sentiment. It will start to put people off from buying the new car, going into the housing market.
It's justifiable in some aspects. I mean, the fact of the matter is that the inflation level is going to get close to the upper band, and just to maintain credibility with, for instance, especially with the international ratings agencies.
The Reserve Bank is concerned inflation is rising faster and will soon reach the upper end of the target band of 3 to 6%. An interest rate hike in the US later this year is adding to fears.
Some of the rent adjustments has already occurred since the previous meeting, but further reaction to US monetary policy tightening could cause inflation to diverge even further from target and set in motion an exchange rate inflation spiral.
Despite valid arguments around inflation, the timing of the rate hike couldn't be worse. Unemployment has ticked up to 26.4%, and job losses are mounting, especially in the mining sector, as a result of increased costs and falling commodity prices.
We've seen cases like Lonmin where they talk about 6,000 jobs on the line, and just at one was in a mining company. Kumba also looking at cutting, production. ArcelorMittal, for the steel sector, looking at being under pressure.
Consumers are paying more for electricity, food, fuel, transport, healthcare and education than they did a year ago. Many are also heavily indebted. However, statistics show a weaker trend in credit demand.
Consumers haven't been taking on a lot of debt. Obviously, some segments of the consumer market are indebted, particularly low to middle income earners, took on quite a lot of debt maybe 2-3 years ago and are still dealing with the fallout of that high debt. But in total, consumers are not especially indebted now.
South Africans have been warned to tighten their belts, clear debt and start saving, as it's going to get tougher. The Reserve Bank gave a rather gloomy outlook of inflation going forward, which suggests that more rate hikes could be in the pipeline.
The Reserve Bank realizes that they've got to move interest rates up. They don't want to be too aggressive about it, because hiking rates by 0.5% at a time and doing it quite quickly would definitely push this economy into recession. So I think they're trying to be as gradual as they can in hiking rates, but they're going to move interest rates up further than where they are now. How much further? Maybe another 100 basis points during the course of next year.
The last few years have been tough on ordinary South Africans, and they may have to endure some more pain before it gets better. The Reserve Bank believes its move to hike rates now will keep inflation under control and protect consumers at a later stage, as the impact of high inflation is more dangerous, especially for the poor. Sumitra Naidu, CCTV, Johannesburg.